Welcome to the Get Real Podcast, your high-octane boost of full-on reality therapy for personal, business, and investing success with your host, Ron Phillips, because somebody's got to tell it like it is.
Hey, everybody. Welcome back to the Get Real Podcast. Ron Phillips here. Today's show isn't a request, but it should have been a request. And that's because we get a lot of people who are asking about these and or don't know about them, don't know why you would use them. And the subject today is 1031 exchanges. And for that, Shane Thompson is back. You guys probably remember him. He was just on the show not too long ago. And Shane has been with the company for a long time. And if you recall, not only has he been with the company for a long time, but he was a client first before he started working for the company. So really long time. And Shane is one of our property consultants, has been for years, and talks to some of our helps some of our really large legacy clients. And because of that, I was talking to Shane the other day and he's like, man, we really should talk about 1031 exchanges and help people understand what they are. So without further ado, Shane is here to help us understand. We're going to have a conversation about all kinds of things. But Shane, let's start off with what is it? And then let's start to kind of move into why in the world would somebody want to do this?
Okay. Yeah. So a 1031 exchange is just a tax benefit, which means you can sell the property that you already own and the gain that you've made on it. So say you bought it for $100,000 and you sell it for $200,000, you're not going to pay tax on that $100,000 increase. If you follow some rules, and there are rules to know about with a 1031 exchange. And the main one is that you have to replace that property with other properties, properties up to 3 typically, that you can replace it with. And there are a couple of timelines, from the time that you sell the property. You've got 45 days to identify the replacement properties. And then also from the same time that you sell the property, you've got 6 months to close on the replacement properties. And the benefit to that is obviously you're not getting taxed and you're growing your portfolio. And I like how, our accountant puts it is that, hey, the tax code is written to incentivize us as investors to go a certain direction, right? This incentive has been provided to keep us as landlords and help us grow as landlords, because the government obviously can't be landlords and people need to rent. And so this incentive is there to help all of us grow our portfolios.
Not only that, we don't want the government being a landlord because they suck at nearly everything.
Amen.
Oh boy. So Shane mentioned the government like right out of the gate. We're not even 3 minutes in. He's mentioned the government. He's got me off on a tangent. I'm already pissed, Shane, and it's not even been 3 minutes into the podcast.
Mistake, that's a rookie mistake there.
It's all good. It's all good. I'll try to dump it. But in this particular case, Shane's right. They incentivize people to own property, to rent it out to other people. And we've talked about a ton of different incentives that they give. This is another one of the incentives. And it's really cool to be able to defer your taxes so you don't have to pay the capital gains when you sell and use the entire proceeds or gain to buy more properties. And so that kind of begs the question, like, if you understand what it is, and there's some other rules and things like that we could get into if we have some time. But where I really want to concentrate today is why in the world would someone want to do this now? There's so many reasons I think that people, and you probably think some of these thoughts as you're listening. Hopefully you haven't checked out already. Because I can hear people in their mind. Well, I have a 2.75% interest rate, Shane. Why would I ever want to sell that property? Or I don't know. Somebody on some other program sometime told me that you buy property and you hold it forever, and you should never sell it because it always goes up. I mean, that's what the people in Bitcoin are saying. I'm never selling. I'm just going to ride this thing, and I'm thinking to myself, yeah, but if you'd have sold kind of at the top last time and then taken your chips off the table, you might not have had to ride that whole Bitcoin thing all the way down to the bottom.
Right.
But hey, it's 100 and something now. So, and I hear it's going to 1 million. So they were right about it going to 100. Maybe they're going to be right about it going to 1 million. I don't know, Shane. I've jumped the track again, buddy. But why would somebody want to do a 1031 now with all of the on a property that has equity in it, but they've got a great loan on it?
Yeah, good question. And this is something, again, as you mentioned, I'm an investor. I've gone through this, and through this evaluation process, right? And this is something that we do as investment property consultants. And so, we're happy to run these numbers for you and see what makes the most sense. So for example, on the first property, that my wife and I bought typically it makes sense in years 4 to 7, in any property that you own, that you've gained enough in equity and cash flow and appreciation, and depreciation, all the benefits that you've usually, basically doubled your down payment. Right. And so now you have this additional money there, and and yes, if you hang on to the property, it's going to continue to make you money. But by selling that property and buying 2 more properties, you're going to basically double your money that you're going to make in the next 5 years, by duplicating that process, increasing the cash flow, increasing the equity. And so what we do is we do that evaluation with you. And so for example, with my first property, after 4 years, it made sense to do a cash out refinance. So that's what we chose to do instead of a 1031 exchange. And the reason we did that was because the interest rate was quite a bit lower than when we bought it. So we were able to do a cash out refinance, have basically the same mortgage payment because the interest rate was lower, even though our mortgage payment was based on a new higher principal balance because it's reappraised at that time of that refinance. And they said, okay, this property that was worth X amount is now worth, $50,000 more or whatever. And then in that case, our mortgage payment was about the same just because of the lower interest rate. And so I thought, well, that's fantastic. We get to hang on to our good cash flowing property, still cash flow the same, and pull out like $50,000 and buy another property. So in that environment, at that time of that evaluation, that made sense to do that. And it made sense that same way again in another 4 years. And so this is part of the reason I think why a lot of our clients haven't done 1031 exchanges a lot, because we went through several years of rates going down. And now that they've gone up, 1031 exchanges are making more sense now. And so on that same property that we owned for several years, we did that evaluation again at the beginning of this year, and the interest rates had gone up. And so when we looked at the refinance, we were going to have less cash flow because the interest rate was higher and the principal balance was going to be higher. So the numbers just worked out and made more sense to sell the property and buy replacement properties with it.
Yeah. And I think, that's one of the things that people get, like blinders, like a horse, and people get blinders. And I say people, I mean the people who are teaching people how to invest in real estate. They teach one way because it's work. I mean, and it would have been pretty easy to teach cash out refinance for the last forever, because interest rates have been so low. Even when they kind of crept back up, they went back down. And I think, Shane, that there's been a lot of people, maybe quite a few people who are listening to the podcast who've been waiting for interest rates to go down. I don't think they're gonna. I don't think they're gonna go down in 2025. If they do, it will be negligible. And so I think that the cash out refinance strategy, it might work. We just have to run the numbers. But 1031 exchange almost always works, and that's the why I think people are implementing this right now. And I want to touch on a couple of things that you said. You kind of, I don't know, you kind of glossed over them, and I want to make sure that we put a big, huge point on them. It seems really simple to you and to me how you sell a property and then you buy 2 more, and why that's better. Because if I've got a bunch of equity, I still have equity and the property's going up in value. I've got great cash flow coming in. Everything seems to be going really well on this one property. So if I sell that one and I buy 2, let's talk a little bit more in detail about why that is better than the current situation that I find myself in, Shane, because I want to make sure that we make it super clear why.
Yeah. So to kind of explain this, I pulled up one of my own properties that we bought in 2018, and it's next in line for 1031 exchange on our own portfolio. And I picked this one because it also has pretty round numbers, right? It's in Oklahoma City. We bought it brand new construction for $185,000 in 2018. So now it's worth about $250,000. And so when we
wait, time out. This was in 2018 where everybody said that that the real estate market was going to crash. I don't know how many people I heard in 2018 saying that the real estate market was going to crash. I'm sorry. Can you just state one more time, Shane? You bought it in 2018 at the top of the market when the real estate market was going to crash for $185. Today, after the market crashed, it's worth how much? $250 after the market crash, from all the gurus out there, everybody, for all the specialists. So sorry, I interrupted you. Okay.
No problem. That is worth emphasizing.
And for anybody who is struggling, there wasn't a market crash. That was all a joke. The market continued to go up. That's why Shane's property is worth $250. Okay, go Shane.
So bought it in 2018. I can't remember exactly what the interest rate was. I'm going to say 5% or something like that. We refinanced it. We did a straight up refinance just to get the lower rate because the rates had dropped so dramatically. Refinanced it in 2021. So we currently have a 3.375% interest rate on it.
Ooh, it's lovely.
So yeah, amazing. Don't regret doing that at all. It was only a few years after owning it. And because of that low interest rate and the appreciation and the rents going up, this property cash flows about $500 a month for us. We bought a brand new construction. I think we've had one maintenance cost on it so far. The garbage disposal went out. So, I mean, it's performing very well. We have a super low interest rate. So it's easy to say kind of what you were saying earlier. Why don't I just hang on to this property? Because based on our original pro forma, when we bought it in 2018, it shows that, hey, over the next 5 years, we should make an additional, $50,000 plus on this property. Not a bad thing at all. That's still excellent return. We've already made an excellent return on the property, and that's fantastic. However, when I run the numbers based on how much cash we'd have available when we sell this property at this sell price of $250, we would have about $100,000. And so with that, we could buy two similar properties. We could buy two more new construction properties around the same price point as what we bought this one originally for, in that $185,000 to $200,000 price point, and basically double our cash flow from $500 a month to around $1,000 a month. And so we're doubling the cash flow. Plus, if you just hold a 3% appreciation rate for all the properties, which is conservative, now we're going to be getting that appreciation on two properties instead of just one. We're owning more land. So we're doubling. So in another 5 years, instead of having $50,000 more, we would have about $100,000 more by having two more properties. So $50,000 is great. $100,000 is a lot better.
That's a great explanation. And let me play devil's advocate, because sometimes I like to do that anyway. And today is one of those days. What if you sell this one that's cash flowing $500 and you buy two more and they're only cash flowing together $500? That doesn't sound like as good of investment as you had before, Shane. Because both of them are cash flowing $250 each, and in total, it's $500. So now what? Yeah.
Good question. You're still getting that double the appreciation. You're still owing twice as much.
Shane's like, look, dummy, I've said this 4 times now. I just want to make sure you out there listening are getting this, because for whatever reason, this is a super hard concept for folks to get. When you take Shane's original property, right, $185,000, and well, let's call it 200 because it makes the math easier. So you have a $200,000 property. If that property is going great, everything's going really, really well, it's going to continue to appreciate, whatever. It's going to appreciate at, let's use Shane's number, 3%. Right. So every year it's 6,000, although it's compounding. So it's more than that every single year. But let's just make the math easy. Right. So 3%, Shane's makes $6,000 on that property. Okay. The difference is if he has two of those, even if the cash flow goes down, he's doubled. Now he has $400,000 worth of property that is appreciating at whatever the appreciation rate is, right? So he's being super conservative at 3, and that's great. So now he has $12,000 a year that is going to compound every year. And that's why, because it overcompensates for the loss of the cash flow. And the only reason that a person wouldn't want to do that, and of course, what Shane's saying is that that's not even going to happen because he's going to double his cash flow. But even if that did happen, you have more assets out there growing. The other thing is you have more to write off. You have more depreciation. You have 2 loans that are getting reduced at the same clip every year by the people who are living in them, right? Your residents in your properties are paying off the mortgages on 2 properties. All of that is going on. So you're getting all 4 returns on $400,000 instead of $200,000. And the big kicker of all of this, which we really glossed over here, how much more money did you take out of your pocket, Shane, to make this happen?
$0.
$0. And Shane has done this over and over again. And that is the magic of real estate in general. But the magic of this 1031 exchange is, I think I've shared this with the company before, Shane. I know I've shared it on the podcast before, but you guys have heard of the penny a day, doubled every day, compounded for 30 days. I don't know. It's some ridiculous number, like $11 million or something. All of that happens at the end of the month, like in the last 3 or 4 days. All of this compounding goes nuts in the last 3 or 4 days. If you tax that penny a day, instead of having 11 million, you have like 56,000 at the end of 30 days. So what Shane is saying here about the 1031 exchange, let's not overlook the fact that we are avoiding all of the gain, the tax on the gain. That is why he's able to do this. If you had to pay capital gains on this, could you buy 2 of those properties?
No, definitely not.
No. And in addition to that, I don't know what it is about. I was just talking to a buddy of mine the other day who's going to sell some properties and wants to try to figure out how to 1031 them because there's something grotesque about paying the government on your capital gains. And I don't know what it is other than that they piss away the money, and it makes me feel horrible about giving. I would rather give it to a wino on the street than give it to them. Nobody wants to do that. Nobody wants to give their money to the government. And the government is saying, yeah, please don't. Please don't give it to us. Please keep it and get another property, Shane, because our population is increasing because we vote. No, I'm not. See there now, I almost kept going down the government track. Shane, you're going to have to save me on the government track. Please.
One other thing I was going to say is that it didn't cost any money out of my pocket. And so one thing that I emphasize to clients a lot is if you basically prioritize investing in real estate for 5 years, you in year 1, say you buy a property with $50,000 down. And then in year 2, you do that again. You basically buy that same property with $50,000 down for 5 years. Then in year 6, a hypothetical example, there's obviously exceptions. Sometimes it's earlier, sometimes it's later, but as a broad brushstrokes, in year 6, you sell the property from year 1, you buy 2 more with no more money out of your pocket. Year 7, you sell the property from year 2, you buy 2 more properties, no more money out of your pocket. So after that 5-year period, you're not having to pull from your own savings to not only continue to sustain this business you've created, but it's continuing to grow at an alarming pace. And so you're doubling every year. And then guess what? In year 11, you're selling the property from the 2 properties from year 6 and making that into 4 properties. And it just grows in that 10-year period. It's incredible what it can grow to. And so that velocity, is really taken into account by the speed up front. Like you said, it really just gets steeper and steeper, that curve towards the end of that. And so every time you have a 6-month delay to pull the trigger on the next property early on, that costs you on the back end so much more time. And so that I have more urgency to do these maneuvers because I'm starting to see the back end of this with the longevity and how long we've been investing this way.
Yeah, I mean, and I think it's really important to note as well, just because everybody who doesn't invest and puts it off for 6 months or a year, like you were saying, people think that means that they lose, they just lose like a year. It's not that big of a deal. You know what I mean? It isn't that big of a deal that they lose a year. But the reality of the situation is that it isn't the first year you lose. It's the last year you lose. And I think that's the thing that people don't think of. Okay, so I pulled this up. Penny a day for 30 days, not 31. So for 30, on 31, it's 11 million something. On day 30, it's 5,368,000. So just to put this in perspective, okay, when you, from day 1 to day 2, which in this example, we're going to use this as years. Okay, so from day 1 to day 2, which is year 1 to year 2, it's 1 penny to 2 pennies. It's so negligible to anyone's life. It's hard. And sometimes when we talk to people, Shane, moving from $500 to $1,000 of cash flow, I mean, it's okay, but what does that really do for your life? Not that much. It doesn't change that much. Okay. However, if you wait and you don't lose day 1, you lose day 30. The difference between day 29 and day 30 is roughly $2.5 million. So 2.684 million to 5.368 million. It is staggering. And that's the thing people don't realize. You're missing the end of the compound curve for every single year you put this off. Every single month you put this off. That's the real kicker here. And that trajectory that Shane's talking about, where these spawn themselves, and people who are like, well, yeah, I can buy one a year. Well, if you buy one a year for 10 years, you don't have 10 years. You don't have 10 properties. You have 20 properties, because the first 5 years, like Shane said, they just bought, each of them bought another one. And the other ones are now reproducing. So it doubles and it compounds so quickly on the back end. But the first 5 years, it just kind of feels, I'm doing something. I got a little cash flow coming in. It's not that big of a deal. And then all of a sudden, you turn into, Shane Thompson.
Yeah, it becomes really powerful in the long run. And that's another question that I get sometimes is like, well, what's the end game? What's the exit strategy? And I think when people ask that, they're saying, when am I going to get this large lump sum at the end of the rainbow? And to me, I would say I never want to do that, because then I'm going to get taxed on it. And so as you grow this portfolio, you're going to have enough in cash flow that's when it's making those life-changing differences, right? When you have 10,000 plus a month coming in on cash flow, then why would you ever sell the properties to cash out and stop that river from flowing? At that point, you're just jumping ship, and you've built this machine that's self-growing. You don't ever want to stop that.
Yeah. So there's some other strategic reasons why people would want to do a 1031 exchange, Shane. And, one of those that we recently talked about was to get rid of the dogs in your portfolio, because even the dogs go up in value. All right. But sometimes you just have some properties that cost money, and they cause, I don't know, they're just a kind of a pain in the butt. And you have this portfolio, and you got one that is just being a pain in the butt. Why not trade up?
Yes, I've definitely had clients do that as well, that sell a property, not increasing cash flow, but increasing quality, getting out of that tenant pool that was all they could afford to get into, maybe as a starter property, and you're dealing with a tenant pool that doesn't have a super stable job. They're coming in late they're damaging the property more. Exactly. Trade up into a more new construction property, or just higher end, more of a B neighborhood type of rehab property. That's definitely another advantage and another reason to 1031 as well.
Okay. So we've talked a lot about 1031s. We've talked about the strategies. I guess one more thing that we should say about 1031 exchanges. And then, Shane, maybe you got something else too that we should talk about, but for sure, I think we should mention that, I hear a lot, people are like, well, at some point you got to pay the piper, right? At some point here, you're going to have to pay the government, and you're going to owe all of this tax on all of these gains from all of these properties for all of these years. It's going to be an astronomical number when you cash out. That's not really, that isn't the way that it has to work, right? Because you can pass the properties on to your kids, and it's a pretty cool thing. I'm actually really not sure why the government has done this one. I mean, this one doesn't make any sense to me. The other stuff, I can make sense of everything they've done. This one I don't understand. No, that's not true. I think I get it. It just hit me. They all own property, so this makes total sense. Okay, so they voted in their natural best interest again, Shane, and you can get your kids can get a stepped up basis, which is kind of unbelievable until you realize that Congress just votes in stuff that's best for them, and that is best for them because they all own properties in Nantucket, et cetera.
Right. Yeah, and I didn't even know this, but I was talking with a client from Canada a few months ago, and I mentioned the 1031 exchange. He was like, "Oh, nope, we don't. Canada doesn't allow us to do that. Even if it is a property in the States, Canada will tax you on that sale." So we have a great opportunity here. I don't know how many countries do it or whatever, but it's a fantastic tool. We might as well take advantage of it since we have it. Not everyone has it. And it's really, we do a great job, and we focus a lot on educating and everything about phase one of building a portfolio, which is buying the properties initially. But this is phase two, and this has way bigger implications for the future growth and the freedom and all those long-term goals. This is that critical stepping stone to get to that point.
Yeah. I mean, we talk about buying properties that are cash flow positive. It is important. Back in the day, you could buy properties that had change your life cash flow, but that's a phase in the market that we will likely never see again. Investing in real estate has always been about wealth creation, and the way to do that is to have as much money out there getting that 3, 5, 10, whatever it is, % appreciation, and have somebody else pay for it for you. And then get all of the tax benefits that we talked about, right? That's the reason. The reason for the cash flow positive is because it's a little business, and you don't want a business that loses money. You want a business that pays for itself while it's increasing in enterprise value, right? And so that's what this is. If you want to look at it in business terms, you're building a business and you're increasing the enterprise value when you add assets that are over time just chucking money back into the company on the balance sheet. And that's what this does. The 1031 exchange is such a great thing. It's a little late this year. You could start the process for next year. But man, 1031 exchange, if you're sitting on property with massive equity, we've talked about return on equity on the show before. You should really run that calculation. Because if you're sitting on hundreds of thousands of dollars or millions of dollars in equity in your properties, I can promise you that your return on equity sucks so bad. When you actually look at the numbers, you may puke just a little bit in your mouth. When you could have had hundreds of thousands more or millions of dollars out there earning 3, 5, 10%, whatever the market gives you. So I encourage you to get out there and make it happen. Any final words, Shane, on 1031 exchanges or anything associated with them?
Yeah. If you bought a property, just to put a timeline to it, if you bought a property in 2020 or before, it very likely makes sense to do a 1031 exchange right now. The numbers are going to point you in that direction. So if you've not already done so, reach out to your property consultant or reach out to us at RP Capital, and we'll help you do those evaluations, run the numbers, see what your specific situation looks like. But 2020 or before, it very likely makes sense.
Man, that's awesome. Well, you heard it straight from Shane's mouth, everybody. Till next time, get out there and make something happen.
This has been the Get Real Podcast. To subscribe and for more information, including a list of all episodes, go to getrealestatesuccess.com.